I'll kick off, and good evening and welcome to everybody. We still have a few joining us, but I thought I'd just kick off with the introduction. Thank you all for your time for joining us today at Cobalt Blue and our guests today at Row Motion. On today's webinar, representing Cobalt Blue is myself, Joe Kadrovic, the CEO. I'll moderate the Q&A and the webinar, and Joel Crane, who's online, who's our Investor Relations Manager, will also join us with a set-piece presentation. And Row Motion's Senior Research Analyst, William Martin, will also be here. So welcome, Joel, welcome, Will. In terms of format, we've allowed 45 minutes in total for today's webinar, with Joel and Will starting with their presentations into global battery trends and impacts on cobalt market, including the recent Inflation Reduction Act from the US. After the presentation, we'll open the webinar for Q&A from participants. Some church notices here on protocol and admin. Today's webinar will be recorded and a copy will be made available on the COB website later in the week. During the webinar, all audio and video will be muted for all attendees. If you want to ask a question, we would prefer that you use the Q&A button. If you look at that at the bottom of your screen, the Q&A button, and then please open the Q&A box, type in your question and click send, and we'll be able to receive those. I will moderate the questions and we'll do our very best to answer as many as we can. In the interest of time, we may group some of the questions if there's a common theme. I'll also read through some questions we received at registration, but please note that we will be preferencing questions addressing the cobalt market and particularly trends as a result of this Inflation Reduction Act, as opposed to questions about Cobalt Blue or waste streams, which we'll leave for a management webinar later. We'll try and address some of those if time allows. During the webinar, if you look on my video and Joel's video, you'll see our contact details, and you're welcome to email questions through in the coming days. Thank you. Joel, over to you.
Thanks, Joe, and thanks for everyone for joining. We're so pleased to provide the opportunity to share developments from us over the past quarter, but also offer market observations, both from our perspective and from one of our favorite analyst groups, Row Motion, who specialize in EV and battery markets. And perhaps even more important, we're so excited to be able to open this up for Q&A, which we suspect will lead to lively discussion as it did the last time we did this. So I'm going to start with just a few comments around current and future cobalt supply and demand and pricing, and then ask Will to discuss the impacts of the IRA and other legislation that we're seeing affect EV and battery markets. Just a few comments on prices. We get a lot of questions given the volatility and what's happened in cobalt over the past quarter. So this chart of cobalt prices really has a similar shape to most other commodities at the moment. Cobalt metal price is down about 35% from its May peak. Look, the overarching macro environment that we're all familiar with is likely the primary cause. GDP growth's likely shrinking in the most major economies, and that's always going to pressure all commodity prices. And likely extending this weaker price cycle into next year, depending on what happens in the macro front. At the same time, cobalt is a China-centric commodity, and so what happens in China does impact the pricing as well. And we're still seeing some impacts from pandemic-related lockdowns and the rolling power cuts that we've seen, as well as the downtrodden consumer electric sector post-COVID boom. So what would turn cobalt prices around is one of the key questions. Look, I think probably the biggest catalyst would be something like the China stimulus, which we're already seeing in the property sector. And perhaps even more importantly, significant easing of COVID policy, which I know everyone's eagerly awaiting some of the outcome of the big meeting over the next couple of weeks. Indeed, we've already seen some Chinese policy changes with another extension of the tax exemption through the end of 2023 for EV sales. So that'll just keep the sales in that sector driving pretty hard. Outside of China, look, obviously a macro recovery or a US dollar strength reversal, and then more legislation similar to what we'll talk about later in the webinar on IRA. But look, this is all probably sort of 6 months away really before you can see a significant turnaround in cobalt price. But look, it's a volatile commodity and difficult to forecast. So for us, we really do look at it on a longer term point of view. For us, the cobalt market looks structurally strong, as the outlook for both EVs and the electronic sector are very, very healthy, with demand growth likely to outstrip supply growth through the back end of this decade and keep prices elevated or at above the long-term average price of about $27. And I note seeing some of the quarterly commodity reviews coming through, some of the analysts, while they're downgrading near-term prices, they are broadly upgrading long-term prices due to expectations of higher cost structures, particularly as energy prices rise. So I think that we're sort of part of consensus there that long-term pricing looks pretty sound. Just turning a little bit to supply, I've constructed this chart just showing the sources of supply growth. No surprise that DRC dominates that, given what we know about cobalt, the global cobalt industry. But Indonesia continues to schedule a bunch of new capacity through its booming nickel sector. Look, we've got some seems like a continuous cycle of announcements of new HPAL projects, with Vale and Huayu Cobalt already agreeing to build a second HPAL. And we expect that to continue to grow and will be a significant source of growth through 2030. That 30,000 tons we've got there, that could be even much larger than that. Year-to-date nickel production is up 40% in Indonesia. That growth rate continues. We'll see even higher numbers than that. We were at a benchmark minerals conference last week, and someone there put up on the screen, even if the most ambitious project outlook could put Indonesian cobalt production at 150,000 tons by 2040. That's a pretty crazy number, but that's just the sort of growth that's really surprising the market. But nevertheless, really any new cobalt supply is welcomed in the market given the expected shortages. But we think there's going to be certainly a different classes of cobalt forming tension in the marketplace over responsible tons. This chart is probably familiar to most observers of commodity markets, looking out into the future of supply and demand balance. In the near term, this year, next year, and really into 2024, because of the ramp up of a few major projects, particularly in the DRC and Katanga and Mutanda and other operations, the market looks to be relatively balanced. And that really gels with the price reaction we're seeing at the moment. Small market surpluses this year, next year, given what we know about what's happened in China, lower electronics purchasing and the shutdowns, the COVID-related shutdowns that affected the battery markets. But growth will slow, supply growth will slow as the pipeline of projects whittles down. And really the only major source of growth, other than of course of our own project, is like I said, Indonesia. So as I discussed on the long-term outlook, more fundamental justification of elevated cobalt pricing over the next 5 years, given this shortage. Look, just before I hand it over, a few observations from us in terms of the Inflation Reduction Act, or the IRA, and other legislation. Look, we view this particular act in the US as looking to be a real game changer for our segment of the battery supply chain. Obviously, there's a lot in the $370 billion legislation, but of course, the important part for us and the rest of our peers is the new requirement of at least 40% of the value of critical minerals used in manufacture of batteries must be sourced domestically or from these free trade agreement friendly countries. And of course, that target increases to 80% in 27 and 100% a few years after. So the initial advantage for us in Australia and our peers will be automakers are rushing to secure supplies that qualifies under that legislation. And given there's not enough in that category, some are just going to lose out. That's going to create tension in the market. And we've already seen real tangible effects of the supply chain, of the interest across the supply chain. For instance, South Korean battery makers are starting to not only rush to secure tons. We've seen some deals with LG and SK On over the past couple of weeks, but to set up more battery production outside of Korea and China in the US. And look, I really do think this might be the beginning of a bifurcated premium market because of this tension for these to secure these type of tons. Prior to this legislation, there was already pushback. For example, Tesla receiving an open letter from U.S. environmental groups outlining concerns over, sourcing nickel from Indonesia. But for us, in the longer term, and the second and perhaps more important advantage will be about end users wanting to secure capacity, mining and processing, meaning players all across the battery supply chain will be looking to invest both domestically and within the free trade agreement friendly countries. And so that's really great news for us who possess that sort of technology and that IP that can be built both on our shores or in the US or elsewhere, either on our own or in collaboration. That's our views on the current cobalt market. Happy to take questions after this, but now I'd love to hand it over to Will, who will give us some insights, greater insights on that legislation and what it means for battery markets, in particular cobalt.
Good. Thanks very much, Joel. Just a quick introduction to myself. My name is Will Roberts, Senior Research Analyst at Romotion. We're a research house and consultancy based in London, focusing on providing the best research and analysis for the whole of the energy transition, but have come predominantly from the EV and battery space. Today, I'm just going to do a quick kind of overview on the EV market as to where we are, and then I'll dive into a bit more detail on the Inflation Reduction Act, what's in it and what some of it means, some of our views on it, as well as a little bit on Europe at the end as well, and how we expect some of those to affect EV demand going forward too. So starting off with our kind of general purpose update slide almost for the EV market. On the right hand side, you can see sales by vehicle class for the last few years. So we obviously saw pretty incredible growth last year of a doubling from 3.3 to 6.6 million units. And we have expected this year, a growth rate that's a little bit slower, up to just over 10 or around 10 million vehicles. And that's actually come down ever so slightly from our forecast at the start of the year. Obviously at the start of the year, we set out our kind of headwinds and tailwinds, and often over the last few years, a lot of those headwinds haven't necessarily come to pass. However, this year, a lot of those headwinds have indeed become major issues for the market, particularly in Europe. Things like the war in Ukraine and supply crunches have meant that the total vehicle market in particular has been impacted, but with the way legislation is set up in Europe, which we'll come to later, this has a more sizable effect on the battery electric market than perhaps in some other regions. On the left-hand side, you can see the penetration rates. So continue to be some pretty strong growth in penetration rates there around the world, which exemplifies that even as total vehicle markets perhaps slow down, demand and the desire for BEVs continues to grow. Particularly the one to note there, of course, is China, which has really seen some massive penetration rate growth, up to around 25% now, and has clawed its way up that table incredibly quickly. Starting to challenge Europe as a region now for total penetration rate, and we'll probably overtake it in very short order. Just want to jump on the next slide. So getting into the Inflation Reduction Act. Here's just some of the top line numbers. It's obviously fair to say that it's a very far-reaching and wide-reaching bill. It's not just an EV-focused bill, of course. As we can see down there, though, in the total investment section for energy security and climate change, that's 369 billion of the total kind of forecasted funding for the bill, forecasted investments out of 437 billion. So it is a massive proportion of what the Inflation Reduction Act aims to achieve. It's fair to say, though, with the Inflation Reduction Act that it perhaps came a little bit out of the blue for many in the industry. Months and months of essentially failed negotiations led up to the Inflation Reduction Act. The Build Back Better bill was supposed to be, the big game-changing act, but Senator Joe Manchin was essentially in opposition to that, and it was only him coming on board with the Inflation Reduction Act and pushing it through that meant this could happen in the end. And the fact that then ended up being so finely balanced potentially led to, an almost tiptoeing through of the bill when it comes to the language within it and some of the writing, it's almost an amalgamation of legislation from a number of places that nobody wanted to change too much for fear that it wouldn't get passed, as there is so much within it. On to the next one. So looking at some of the key points in the Inflation Reduction Act for the EV sector. One of the headline things, I guess, is that manufacturer limit of 200,000 has been removed. This was something that was generally in agreement from most of the big OEMs, particularly legacy in the US. Of course, Tesla and GM had already hit this limit and so had become ineligible for the credit up until this point. So this is, of course, particularly helpful for them. But the likes of Toyota, Ford, and Stellantis were all getting very, very close to this limit too. And so this really needed to be removed if it was going to open up the bill to essentially people that are selling EVs. So yeah, good news for the larger OEMs on that one. The 7,500 amount remains. That's the same amount as it was previously. However, now it's been split into these kind of two times 3,750, given that criteria are met. So that's those battery components criteria and the critical materials or critical minerals criteria that Joel briefly mentioned earlier, and we'll jump into more detail on those very shortly, because of course they are going to be the big limiting factor or the big news within this bill, really. Some of the other things, though, the MSRP restrictions, so $55,000 for cars and $80,000 for SUVs and pickups. Some other OEMs, particularly the smaller ones, the startup ones, have picked up this a little bit. Saying it's potentially unfair if you're trying to break into the market, that you're more likely to be selling higher margin, higher price, higher ticketed cars because you're at a very small scale and therefore going to be ineligible to receive the credit. And while that is true, often these startups, they start by targeting the premium sector anyway, where perhaps your customer base is going to be less exposed to needing that credit to start with, smaller volumes to start with anyway. And what it potentially has the benefit of is that if you're already going to be ineligible for the credit because your SUV or pickup is $100,000 plus, then maybe you don't have to worry about the battery component and critical minerals stipulations at the start of your kind of production life cycle, giving you maybe a little bit more leeway just when you're getting production off the ground. Income limits as well as $150,000 and $300,000 kind of feeds back into the same point. If those higher earners are looking for startup vehicles like Rivians and Lucids, then maybe it doesn't matter so much for them. And just the final one I want to talk about a little bit is the advanced manufacturing credit. So this is going to be really important for growing the battery industry within the US. It's 10% of production for cathode, anode, and active materials, and then $35 per kilowatt hour and $10 per kilowatt hour for cell and module production, respectively. So that's potentially up to $45 per kilowatt hour for battery kind of cell manufacturing within the US. That's going to be a massive amount. And looking at the kind of forecasted numbers that the CBO have put out, and in response to those numbers on the previous slide, they're almost looking a little bit low. Taking a look at the forecasted gigafactory capacity within the country, and just essentially multiplying by $45, you get to around $30 billion peak in 2029 that could potentially cost, which is far higher than the CBO have recorded. So it remains to be seen how that plays out, and as to whether they've potentially even underestimated how much this might cost in investment. So on those rules of origins, as Joel mentioned, these are going to be particularly important. Both of these have to be met in order to access 100% of the tax credit, but meeting just one of them will enable 50% of that tax credit to be received. So critical minerals, which must be extracted or processed or recycled in the US or a country that has a free trade agreement. And we can see those countries with the free trade agreements in force in the bottom right. And then for battery components, which again is cells, modules, and electrode active materials, must be manufactured or assembled in North America to access that other 50% of the credit. And we can see there how it starts at 40% for critical materials and 50% for battery components, and rises pretty steadily up to 100% in 2029. So I think some automakers as well have come out and pushed back a little bit on this, thinking this very soon, it's very hard, it's very fast, which it absolutely is. But I think as well our view is that hard legislation like this is exactly the kind of thing that actually gets an industry moving in terms of moving its supply chain quickly towards essentially the desired goal. It's the kind of hard legislation that we've seen in China and that we've seen in Europe really start to grow the industry, in a different way. But if that's the goal that they're looking to achieve, then going hard and going quickly is certainly a good way to go about it in that sense. Just want to jump on the next one. So this is data from the IEA's EV Outlook 2022. We can see where the kind of proportion for EVs of mining, material processing, cell components, and EVs comes from. So in that mining and material processing area, this is where the most beneficial, most preferential treatment even is if those operations are based in the US or free trade agreement areas. And then for cell components and battery cells, really you need to be based in the US to be getting maximum benefit, and then EVs need to be made in North America. And we can see obviously at the moment that the dominance that China has in many of these sectors. And the issue that's going to be here is there's this stipulation on foreign entities of concern. So starting from 2024 for battery components, and starting from 2025 for critical minerals. So for those battery components, if they're manufactured or assembled in a foreign entity of concern, and for the minerals, if they're extracted, processed or recycled in a foreign entity of concern, if any of that material comes from that foreign entity, then the car will be ineligible for the tax credit. So with OEMs looking to receive the tax credit, they're going to have to immediately diversify away from China, Russia, North Korea, and Iran. Obviously, China and maybe a little bit Russia being the key ones there. You see this as potentially more difficult than the 40, 50, 60% stipulation that we've seen on the previous slide, because even if you can get 40% of your material coming from the free trade agreement zone, if any of that other material comes from China, you've immediately wiped out the benefit of getting that 40% material secured anyway. So yeah, this becomes a really important part of the bill for sure. If you just want to jump onto the next slide. So this is a slide that my colleagues put together on kind of the supply gap to the US for mined and refined cobalt. And so we can see in the dark blue there the free trade agreement countries and the supply that they'll be providing out to 2030 and beyond. And the grey is the kind of non-free trade agreement countries. Obviously, we can see where that US cobalt demand base is on the right-hand side, and how free trade agreements are going to start being nearish, but gradually not be so close to that demand, which is really going to create that elevated, desire to reach that free trade agreement cobalt. I think, as Joel mentioned, creating that kind of split in the market between almost a premium product that meets these requirements is very likely to happen. So if we just keep going, then we'll have a little chat about Europe. So as I kind of alluded to, some of the legislation in Europe has really been what's driven this market forward for quite a while now. And what that really comes down to is the emissions legislation. So it's been at this kind of 95 grams per kilometre CO2 level that people have been talking about and trying to meet for quite a while. So the way this works is that the fleet average of all vehicles sold in Europe has to be 95 grams. But each individual OEM gets its own target based on the kind of weight of vehicles, type of vehicles that they sell. So for instance, Range Rover's target is much higher than Peugeot's target, just due to the fact that they naturally sell larger vehicles. But this increases this, even though it's kind of in this step change format, it does get more difficult every year as they gradually remove kind of loopholes and super credits and things like that from the legislation. But recently, a new proposal to really toughen up that legislation as we move into 2030 has passed in Europe and is now extremely likely to make it through the EU Parliament and become the new kind of standard. So what that would mean is from those current levels, which are already doing the job for the EV market, we're going to see a 55% reduction from 2021 levels in 2030, and then a 100% reduction in 2035. So that's an effective ICE ban in 2035. Remains to be seen whether there'll be some mild stipulations for potentially hybrids in there, but at the moment it's looking like essentially BEVs or fuel cells, I suppose, in 2035. But maybe the more difficult thing is meeting that 2030 level. It's obviously much closer, and where previously, based on our analysis, you're able to get quite a heavy amount of HEVs in there, so just mild hybrids, not plug-ins at all, and able to bring you down to near that level. Now those are effectively just not going to be good enough in order to help the averages be low enough if you're still going to be selling any ICE vehicles in that time period, which of course OEMs will be. And then if we just jump up to the final slide, something which is going to make this potentially even more difficult is the EU having a second look at what they've decided for PHEVs. So currently their grams per kilometre level sits around 44 grams, which is, with BEVs of course being 0, HEVs in the high double figures, or over 100 grams normally, then these become very useful for meeting those targets at a 44 gram level. However, this is based on a utility factor, which is assuming how much that PHEV is being driven in electric mode versus petrol mode. And currently that utilization factor is particularly high. So you can see there with a PHEV range of around 100 kilometers, we're assuming like a 95% utilization factor. And I think kind of multiple independent studies have looked at that and gone, not sure. And now the EU is doing the same and is looking at that and saying, well, that's just not quite accurate anymore. So the review of that is likely to massively increase the average CO2 emissions for PHEVs up to maybe 86, 125 grams per kilometre there. And in a similar way to HEVs, with that tightening emissions legislation on the previous slide, it's really going to make PHEVs an extremely difficult technology to help meet those targets. And you can see that in our kind of 2030 BEV PHEV split. We've now drastically kind of reduced that from 18% down to 10%, based on the fact that this is coming in. So in a bit of a roundup, I suppose, talking about the Inflation Reduction Act, of course, the incentives are welcome, and the widening by removing that $200,000 credit is certainly going to help many more people. In terms of near-term impact, it's almost, we almost see it as not having too much of a very near-term impact in the next 1, 2, 3 years, because localizing those supply chains in time is going to be incredibly difficult. Never mind the fact that bringing all of that in that short period of time is looking quite unlikely. However, and also those OEMs have set up their production cycles for the next 2 or 3 years. It's very difficult to double, triple, quadruple those based on the back of this legislation. However, where we do see it becoming really important is potentially later into the decade, as that penetration rate in the US increases, and you start reaching the customers that need to buy EVs that perhaps at the moment are sensitive or say they never would, and need a bit of convincing, i.e. a tax credit. That's also the right kind of timeline to start making these deals with free trade agreement suppliers, and localizing those supply chains in terms of battery manufacturing as well. So that's where we start seeing that becoming really important. Thanks very much. I'll hand back over to Joe.
Thank you, Will, and thank you, Joel. Excellent presentations. Perhaps if I can kick off with a question to you both, and maybe actually, Will, over to you first. You touched on some of the so whats and what behaviours you expect, and you mentioned this is not an immediate set of behaviours you expect from industry, but 2 questions for you about that. Firstly, from a vehicle OEM perspective, what behaviours would you expect in the next 3, 4, 5 years, when the rubber hits the road on this legislation. So what behaviours do you expect from those OEMs? And the second question, how do you see that manifesting itself in terms of an integrated production chain, maybe from FTA countries onwards? So not just the individual OEMs, but how do you see the overall industry reacting to this legislation?
Yeah, absolutely. I mean, OEM reactions to this is of course going to be what drives it forward and what is the ultimate benefit of the act. So, you know, at Remotion, we try and speak to as many OEMs as possible every quarter when updating our kind of quarterly outlooks. And speaking to the guys in the US, you know, like I said at the top of my presentation, not only were they perhaps a little bit surprised with the speed that this legislation came through, but you know, in some ways, essentially giddy with excitement as well because of the opportunity that it affords them. Some have already been looking to localize their supply chains anyway, just in terms of supply chain crunches that we've had over the last couple of years. And so I think in terms of behaviors expected over the next 3, 4, 5 years, it's definitely creating more deals to bring battery manufacturing as well as cathode and anode manufacturing into the US. But of course, receiving that material and making those deals right the way up the supply chain. So securing materials with you know, kind of the initial extraction point being, I guess, kind of overseeing it through its processing stages, and then ultimately into the US, into that hopefully localized supply chain. I think we're also going to start seeing more bets and larger bets even on you know, emerging companies. We've seen, you know, in Joel's presentation how that kind of demand and supply for Cobalt is looking pretty close and maybe falling off near the end of the decade, and that's true for multiple materials necessary within the space. And so yeah, like I say, we started to see OEMs go for those more speculative deals as well, just because it's all going to be needed essentially. I think GM and Livent is quite a good example of this, putting down capital, I think $200 million or something straight off the bat, seen as quite a big move up front.
Yeah, it's going to affect, you know, all across the supply chain. I mean, just last week, a near-term Australian graphite producer vastly increased its initial capacity because of extremely elevated customer demand for its anode products post this legislation. So they're just essentially having to double down on their original investment. And I think that's, you know, we're going to see these type of announcements on a weekly basis as the FTA-friendly country producers try to vastly increase their capacity to enter into that gap that was highlighted in the chart that I showed that looks like not only in cobalt, but so many of the other commodities.
Thanks, Joel. Thank you. Will, one for you. Just coming back to the presentation with respect to the price cap of $55,000 US as being the limit for the credits. Can you give us an indication of how many vehicles would be within that pool? And then I guess the catch-22 follow-up is, of those, is that a segment that can support a premium for those materials in the first place? Because you are trying to fit a larger cost base in I guess a more midstream, more mass market product. But over to you.
Yeah, we've had a couple of conversations internally about exactly how this is going to work. You know, it's something that is true essentially across all of these stipulations within the bill, is that we're still all waiting for a lot more guidance from the Treasury on exactly how they're all going to work. That goes as much for the critical materials as it does for something like the $55,000 price cap. And my understanding is the Treasury is essentially still putting together the team that's going to be dealing with all of these issues. So, for instance, on that price cap, is it if you just hit your base model at 55K, is that going to be okay? If I add a $1,000 heated seat package, is that going to push me away and lose me out on $7,500? It's not entirely clear. Can it support a premium segment? I definitely think there is space for it to do that. You know, we saw the F-150 Lightning launch at $40,000, and that's an SUV pickup, so that would have even had, you know, room to double its price to $80,000, while still receiving the tax credit. We're still as well in early stages, even with EVs. I know it starts to feel like a more mature conversation, but in terms of things like EV dedicated platforms, even, which are going to be crucial for making the best cars, but also the most cost-effective cars, we're only really starting to see them come through in the last year for any OEMs, and most BEVs are still based on kind of a job ICE platform with a battery in it. And so once all of these things kind of start to come to pass, hopefully that's where we start to see prices be a little bit more sensible in relation to ICE vehicles. And I think there's definitely room with underneath that $55,000 cap for those vehicles. And in fact, we'll probably see a bit of a segmentation where quite a few vehicles sit in that 52 to 55K bracket, and quite a few vehicles sit in 75 to 80K bracket as well.
Okay, but if I had to put your feet to the fire and say, just broadly as a percentage of the mass passenger market on a, say, a BEV vehicle on a base model basis, just roughly what percentage of the consumer market would lie under that sticker price?
It's not something I've done the exact analysis on, so I'm sensitive to give you an exact number, but maybe at least half, I think, would be a best guess at the moment.
Okay, no problem. Thanks, Paul. Joel, over to you. For EV minerals that don't make the cutoff for being green, and I assume that's a label for incentivized, consumption, either being green in the sense of their origin, or being incentivized in the sense of IRA and other tax credits from FTA countries. When you talked about a bifurcated market, could you elaborate on that, and how do you see the non-green EV materials faring as a result, and then give us a bit of a forecast of how you see the market evolving in the next few years?
Yeah, sure. It's going to take. It's not going to happen overnight, obviously, because this market has been has existed in this format for many years. And look, what's going to happen, and as I alluded to at the beginning, it's just going to create this tension because there's just not enough of that green material, and so that's why I think there will be a type of premium market to be that'll evolve. But basically, there's just going to be a lot of losing procurement teams and end users who aren't going to be able to secure that in time. We've been in a lot of commercial negotiations with procurement guys who are clearly almost at a panic level, that they, some supply contracts run out in 24, 25, and they need to secure a better contract than they had before because of this. So the scramble is on, and that's why you're seeing almost daily announcements of tie-ups between battery makers, OEMs, and mining companies and refining companies because of this. At this point, given how large the Chinese market is, a lot of that material is headed, the non-green material is headed straight there. So almost anything that's produced in Indonesia goes straight into the Chinese market. So there still is a sort of a sweet spot where there is enough material, to hit these early targets, but it's just going to become very quickly a race to the top in that sense. And I think that's going to incentivize more production of battery materials in the FTA-friendly countries.
Okay. Thank you, Joel. I've got a question here that came in earlier, and I need you to put your economist hat on here. What do you believe the impact on the broader EV minerals industry will be as a result of the UK meltdown and US inflation at the moment? How do you see that impacting?
Look, I think these are short-term, headwinds, obviously. UK is not, as we saw in Will's chart on EV penetration, is not a super important market for EVs yet. Will be. So I'm not too concerned about that. It's similar to what's happening in the US, and obviously the legislation to provide those tax incentives to help through this process is going to help. But the short answer to the question is, I don't see any major impact in the near term and hopefully there's enough stimulus and incentive packages to keep these markets buoyed. And I really like the point that Will made earlier, is that these countries are really trying to play catch up to where China and Europe had been, or already have been, in terms of launching that sector. And I think they're just going to continue to push that type of legislation and incentives to get them.
Okay, and back to you again, Joel. A couple of questions, one on screen, one here earlier about reducing cobalt and EV batteries and the trends you're seeing. We've heard you speak before about your beliefs. Could you reiterate those and maybe update them with anything?
Sure. Certainly, there's been some thrifting of cobalt into away from the nickel cobalt technologies into LFP. So far, that's strictly been a China phenomenon. That's really only occurring there, where range anxiety is not a big of an issue, and similar to other dense populations. So that certainly occurred, and I don't think that it's going to come back from that. You're going to stay at those higher levels of LFP penetration. But in the more importantly growing demand markets of Europe, US, and elsewhere, the LFP market is just not going to take off to the same extent because of that range anxiety, because of just different consumer behavior around driving vehicles and the requirement for battery efficiency, which nickel and cobalt technologies provide. So look, the more cobalt that gets into the market, the better for us, because you don't want to have those you don't want to have insecurity of supply and high prices. So that's really part of the reason we're trying to get there so quickly, Joe.
Just to add on that as well, I always think it's important to remember with this that even if LFP stayed at its penetration rate or grew even, it's always important to remember that the global penetration rate of EV sales is still very low. The global fleet level of EV penetration is single percentage points. There's a long way to go in growth, and nickel cobalt chemistries are definitely going to stick around and be part of that growth. So overall growth is definitely still there.
Thank you. I've got one final question for you both, but before I ask it, I'll just apologise. There's a bunch of questions which came in ahead on the registration. A number of them to do with waste streams, a number of them to do with a comparison with cobalt refining, etc. For those who didn't hear those answers, or obviously didn't get a chance to pose those questions, please pose them directly to us and we'll come back to you on that. But I do believe that the management webinar, which comes across every quarter, we can answer those ones more specifically. So the final question to you both, key risks. I mean, given what you've seen evolve in the last 6 months or so of this year, or 3 quarters of this year, given the legislation overlay, given some of the economic issues you're seeing, as you sit here, what are some of the key risks on your modelling that you can anticipate in the next 1 to 2 years, and give us an idea of what the outlying issues may be. Will, I'll give you the courtesy of a moment to consider that and put the acid straight on Joel.
Sure. Well, given that parameter of 1 to sort of 2 years, we just can't ignore what's happening in China. You never can for any China-centric commodities such as cobalt, and it's clear the impact of what's occurred there in terms of the demand decline from the electronics sector and from COVID-related shutdowns. So going forward, I know there's a bit of market anticipation of some stimulus and trying to reinvigorate demand, particularly from the property side, which, as all China watchers would know, anything that affects property affects the other major sectors such as consumption, electronics, which I'm referring to. Should that stimulus or support not come through, I think it could continue. That could put a lot of pressure on commodity prices, including cobalt, simply because of the worry over how the world's largest market for these commodities is going to fare. So biggest risk remains China. Outside of that, look, I just worry about price spikes to the upside in the way that can sort of spook battery makers. We prefer a more steady cobalt price, right, sort of around these levels. So as long as we have more efficiency in the markets, we can be sort of rest assured that we're not going to scare away long-term customers.
Thank you, Joel, and over to you, Will.
I'll try and stay a little bit in my lane on keep it to maybe challenges for EV demand particularly. I think starting with Europe, there's definitely a lot of consternation here about price rises, cost of living rises, the cost of energy, both domestically and commercially. We've already seen the price of EV charging essentially go through the roof here in the UK. Some fast chargers are at now £1 per kilowatt hour, which pretty much makes you more expensive than driving a nice car if you were to only fast charge with those companies. So that's likely to impact people's decisions on whether they're going to outlay on an expensive ticket item. Of course, supply chain challenges as well. The semiconductor issue is something that we've been talking about for a couple of years now, and it's starting to feel like an old talking point, but unfortunately it is still incredibly relevant. It's definitely not abating at the end of this year, and it's likely to stick around probably for the whole of next year as well. Bringing supply online for semiconductors is an incredibly long and expensive process that isn't always necessarily targeted directly at the automotive industry as well. And it takes a little bit for the automotive industry who need to recognize that they need to adapt as well on their end with what technologies they can use. In the US, I suppose similarly with kind of inflation and price rises there. However, the direct impact on the total vehicle market that supply chain issues may have won't necessarily have the same effect on the BEV market as it will in Europe. Growth there is, almost a lot more OEM driven, and people like GM, people like Tesla and Ford have big plans for the next few years. So that growth is almost baked in, and the demand is definitely there for it, especially from their kind of low base at the moment. In China, definitely see fewer headwinds in a way. Growth is still incredibly strong there, and like we've seen with that penetration rate, pretty rapidly growing. The likes of BYD have just exploded in the last year, and don't show signs of slowing down at the moment. However, there's always the risk of COVID lockdowns having a massive impact there, as they did kind of March, April time this year. So remains to be seen whether we see any government level policy changes on that front.
Well, thank you both. It's been a stimulating conversation, and I hope that listeners got a lot out of that, because in particular the legislation you spoke to, Will, has come at us fairly quickly. So look, I'd like to wrap up and thank everyone for attending today. We enjoy giving these presentations. The next one from Cobalt Blue will be a management webinar where we more focus internally. A recording of this will be made available next couple of days on the COB website. And until next time, I say goodbye. Thank you.
Thanks, everyone.
Thanks very much.
And thanks, Will.